I'm joined today by Paul Jourdan, who runs the Amati UK Smaller Companies Fund. Hello, Paul.
Hello.
So lots to talk about. There's a big argument at the moment about growth versus value. Now, value has been the pain trade for a number of years. But now, given we're talking perhaps late cycle, there's a view that sort of value may be the strategy to follow at some point in the very near future. You being a growth fund, I mean, what do you think of that?
Well, we're a growth fund in the sense that we aim to invest in companies that can grow. Clearly, I think one of the problems with those labels that everybody seems to love about growth and value is that all investors think they're buying good value shares, otherwise they wouldn't be buying them. So just because we're growth investors doesn't mean we don't look at valuations. And this whole business of valuation, I think, is probably underexplored in markets generally and in the literature. And so we end up with a very crude distinction between, are you a growth investor or are you a value investor? Or are you maybe a growth at a reasonable price investor? And we come up with different flavors of the two different things, or maybe value but not looking for value traps. All of that terminology we don't really let that drive our process. We're always looking to make the best investments we can find. I think in times of innovation, as we're in times of where you're seeing big industrial changes, those are going to play to investors who look for growth. And you could imagine different kinds of times completely, and I think the 1950s was maybe a very good example when Warren Buffett made his name as a value investor, supposedly in inverted commas, although he later changed to being a growth investor. Then when there's a lot more stasis around and big companies remain dominant and there's very little that can challenge them, then maybe there's a case to be made for a different style of investment. From our point of view, we simply weigh things up against each other and we try to find the best investments that we can.
Well, look, at the moment, the portfolio, as I understand, is about 9% cash. I mean, it sounds quite high to me. Is this typical? Is there a specific reason why cash is not around 9% right now?
There is a reason, and you're right, it is high. It's higher than we would normally carry. And having said that, we've carried a similar level of cash for many months. And it's really our response to what is a high level of short-term uncertainty. So if you like, it's a tactical decision to carry cash. It's not a strategic decision. So it's not to say that we think by carrying 9% cash, if there's a big market fall, that's all we need to do and it's going to protect us. Because the amount of cash you carry is never anywhere near as important as the kinds of companies that you invest in. But there are reasons tactically why we want to carry cash, given the level of uncertainty there is. And if you like, it allows us to keep our options open. So specifically at the moment, we have, over the last few months, we've had some scenarios which would have been very negative for markets in the short term, some scenarios which would be hugely positive for markets in the short term, and we don't know which one's going to arrive, and we don't really want to be in the business of just trying to guess and take a very big position assuming that we know, because we don't know. Whereas carrying that level of cash means we can tilt the fund either way once more evidence becomes available. So it's simply reflecting uncertainty. We don't tend to go above that kind of level, and if you start to go above that level, then that becomes too big a decision to make. But 9% cash up to 10% is really a useful tactical step when there's a high level of short-term uncertainty and you don't want to take a strong view on which way that's going to go.
And we're talking about Brexit uncertainty.
We are,
mostly,
Brexit uncertainty and, of course, general election uncertainty beyond that and mixed in with it.
So do you think at some point, once everything unravels and that we do have more certainty, depending on what that is, do you think then you're ready to deploy your cash, and might that mean that other funds are perhaps doing similar things, and that there might be this sort of a wall of cash to come to the market?
It's possible. I can't say what other funds are doing. Of course, it's probably likely that in times of uncertainty, most people raise a bit more cash than they would otherwise have. So yes, it does. We're very cognizant, as is everyone, of the fact that if the Brexit uncertainties get removed in a benign way, then there's the potential for very significant rallies in certain segments of the UK domestic-facing stock market. Equally, if that doesn't happen, then or we have some political changes that are taken badly, then there's the potential for the exact opposite to happen. So if you like, we're hedging our bets.
I mean, you like financials. They account for about a quarter of the portfolio. I guess the type of company that you invest in won't be, or a lot of them might not be familiar to retail investors. They're not necessarily the high street lenders. I mean, for our viewers, could you just give us a flavour of some of the companies perhaps which make up the portion of financials in your portfolio?
Yeah, they're very varied, and you're right. It has become a big segment of the portfolio. That's not really because we said, now is the time to buy financials. And going back to what I was saying earlier about late cycle behaviour, it's not the most obvious thing to do. But the UK financials, the financial segment of the UK stock market is incredibly varied, and we think it's got some brilliant businesses in it, which is why we're heavy investors in it. So thinking about our big positions, the largest actually at the moment is One Savings Bank, which is a specialist buy-to-let mortgage lender that's really focused on lending to professional landlords. And if you like, that's one of our key ways of having something in the portfolio that will do very well if the Brexit uncertainty is removed in a benign way. I think we think it's derated very, very significantly because of fears over a major crunch in the housing market, which we think is unlikely to happen to anywhere near the degree which would be required to seriously upset One Savings Bank. So it's become a Brexit-sensitive stock, whereas when we look underneath it, there are all kinds of regulatory reasons why it's thriving. It's growing in a market that might surprise people that it's possible to grow because overall the buy-to-let market's been under pressure as individual landlords have been squeezed out by government rules, whereas the professional segment of it has been really thriving. And yet within that, because the big banks aren't really are not playing a part in lending to large professional landlords, there's a big opportunities opened up for the specialists. So it's very specific why we're investors in that company. And then the next one on our list in terms of size is Intermediate Capital Group, which is a fund management business. Used to be primarily a balance sheet investor. And it's a very specialist investor which has built its business over a long period of time. And it comes from a background of investing its own money into private equity debt structures, and that already sounds quite specialised, and it is very specialised. So when a private equity company might buy a highly cash generative business, typically they'll put more leverage into it than the banks would lend them, and they go to certain kinds of funds to get the leverage. And Intermediate Capital Group has long specialised in that area. And then over the past decade, the reason why the business has become interesting to us is because they realise that the asset class in which they specialise and which they have broadened out from simply buy-to-let leverage to more infrastructure leverage. It's always debt focused, but investing in very large asset classes in markets which are unquoted, and they're using the right structures to do it. So they'll normally use limited life partnership funds to do that. It turns out that there's some of the largest institutional investors in the world, whether it's sovereign wealth funds or the very large pension funds, are very happy to make the trade-off between giving up some liquidity for higher returns. And in a low yield, a low interest rate world, that trade-off has become more appealing. So Intermediate Capital Group have very successfully turned what was primarily a balance sheet investment business into an investment management business, and now of real scale, investing 30, 40 billion euros of funds, and it's got the potential to grow significantly. So with an eye to the future, we think strategically this business is very well placed, and the underlying demand for the types of funds they run actually exceeds supply. So we can see many years of growth to come from that business.
So Intermediate Capital has done incredibly well since the credit crunch. Now I know you haven't owned it for that entire period, but it's still done very well for your fund. But if you were able to own just one stock, one company, which one would it be?
Yeah, it's a tricky question. It's a desert island discs kind of a question, that. And of course my answer would have to be that I wouldn't own just one company. We're big believers in the benefits of owning a portfolio of companies. But I would put Intermediate Capital Group right up there with the stocks that if I couldn't own very many companies, I would want to have in a portfolio.
Okay, that's a fair answer. An unfair question. But given everything we've discussed, where should private investors be putting their money right now, do you think? I mean, you've talked yourself about uncertainty. It's why your cash levels are particularly high. And I know you won't impart advice, but I mean, what's your top tip for investors at the moment in terms of how they should approach the markets?
I think it's always tempting when we're going through such political volatility to run away from markets, and in a way there's a danger of becoming too scared and worried about what's going to come around the corner. And clearly, you know, the anxieties are perfectly understandable, but it's best never to assume that you really know what's going to come around the corner. So yes, you need to make sure you're not over-investing, but equally you need to make sure that you're not being tempted into becoming so afraid that you get run out of the market because you think you know the next thing's going to be bad. We simply don't know, and there are many scenarios which a lot of uncertainties gets resolved quickly, and you know, so if you don't want to get caught taking big decisions based on the political headlines. It's better to take a longer term view, and I think the best place to invest long term money is still in businesses that are well run with growth characteristics. So I'd make sure you have some exposure to them.
Cool, thank you very much.